Hello, everyone. My name is Chris Kachmar. I'm a partner and chief market strategist at Fiducient Advisors. I'm joined today by my colleague, Brad Long, who's a partner and our deputy chief investment officer. And today is our third quarter capital markets update. The intention is to spend the next 10 minutes or so running you through some big picture themes and then some of the reactions in the capital markets as you get prepared for meetings in the coming weeks. Couple of big picture themes to think about, just in terms of what's been influencing investors in the way they're thinking about markets currently. We certainly have an evolving Fed message that we'll spend a minute or two on. We have a good deal of policy gridlock in Washington that you've been reading about, and moreover, of course, and unfortunately, we've got the lingering challenges presented by the Delta variant. Let's start with the Fed messaging for a little bit. We show you here a depiction of the dot plot and expectations around what may happen with interest rates. Before we get into that detail, we'll just remind our listeners today that you'll remember the Fed is also beginning to engage in tapering their asset purchases. And that's expected to commence likely in November, probably carry through the middle of next year, and then in all likelihood will begin to tackle the interest rate issue. And you do see here market expectations starting to increase, both in terms of the magnitude of those rate hikes and potentially the timing being escalated as well. So that is certainly a challenge for the Fed and something that they're going to have to weave through fairly carefully. Despite those challenges, one thing we would remind our listeners to be mindful of is that the consumer health of consumers financial health remains very, very strong. So household net worth here you see has jumped pretty dramatically since the onset of the pandemic. Debt levels have actually at the same time been reduced a good deal. You see in the chart there the depictions of those trends, and that of course is important because consumers are 70% of the economy. So one school of thought that we're mindful of is that, well, we've got some of these near-term challenges and frictions in the markets, that this consumer financial strength may ultimately serve to be the bridge to more sustained economic momentum on a go-forward basis. Playing on just another theme is what's worked best in the markets more recently, and you see there in the third quarter, kind of a return back to the what happened at the beginning of the pandemic, where we had growth names leading, we had large cap names leading, and some of those areas associated with reflation trades and the like, value and small caps and internationals to an extent underperforming. And that's what we had in Q3. That's very different what we had in the two previous quarters. And it is interesting, right, that it does align with this idea that we've had some of these headline challenges, some of these concerns about the trajectory of the recovery and the pace of the recovery. And when we've had some kind of frictions on those fronts, you see the market kind of return to these areas of comfort, if you will. And that certainly is something that we're spending time monitoring and expect we'll see this, kind of different sectors waxing and waning along the way here as investors dial into what's going on macroeconomically. A couple of high-level economic data points to share with you. So you do have real GDP expectations depicted in the charts to the left-hand side of the page, and they still, on balance, remain very robust, right? And kind of reflective, I think, of pent-up consumer demand, the robust household financial situations that we talked about. Expectations for growth this year globally center somewhere around 5.5% to 6%. Next year, somewhere in the 4% to 5% range, depending on who you talk to. And all things considered, despite some of these headline challenges, right, there is an undercurrent and an expectation for the economy to continue to grow and grow at a fairly decent clip. The other big thing that certainly you've read about and investors are grappling with is the idea of supply chain disruptions. So in the chart to the right, we show an inventories to sales ratio figure for you, and you do see there some of the challenges on that front that businesses are having with these supply shocks and declining inventories and getting product to market. A byproduct certainly, right, of the very quick rebound in demand that we had after the pandemic first took hold, and we'll see on a go-forward basis to what extent some of these measures to alleviate these pressures begin to take hold. world. And some of that, as you know, centers on ports operating with 24-hour, 7-day-a-week schedules, and moreover, some of the large-scale retailers beginning to extend their hours of operation as well. And maybe these frictions begin to work their way through the system, and some of these pressures alleviate a bit. And then really the topic, I think, du jour, and that everyone is spending their most time thinking about, as are we, and that is what's going on the inflation front. Certainly you see there, if you're looking at either headline or core CPI numbers, inflation is notably higher this year than it's been in some time. Those supply chain disruptions just mentioned certainly are a cause of some of those pressures. We've had fairly rapidly rising energy prices. You see the depiction of oil prices to the right, north of $80 a barrel. You kind of join that with some of the challenges, supply challenges with gas and other sources of energy overseas, and slow for energy to come back online in terms of output. And you've got that as a pressure, and then we're coming off a low base as well. The Fed narrative, as you all know, continues to center on the idea that some of these pressures are transitory. We would generally share that notion, and are certainly mindful, though, that they may prove to be a bit more nettlesome than perhaps we first thought they might be. What I would offer up, and it's not on the page here, but is an interesting comparative, 10-year break-even rates today are at about 2.6%. They were as low as 50 basis points back at the start of the pandemic. But remember that 2.6% or thereabouts frames versus a long-term average of a little bit north of 2%. So this idea that investors are holding right, that inflation might be a bit elevated, but not to levels that challenge the pace of the economic recovery is something certainly to consider and be mindful of on a go-forward basis.
So as we move into capital markets and asset classes, you can see a lot of these themes that Chris just mentioned throughout the slide here. So just for slide orientation, upper left, dark blue bars, fixed income, middle gray, if you will, is equities, and then light blue is real assets. So there's no coincidence that among investment grade bonds over the quarter and year to date, your best performer here is TIPS, Treasury inflation protected securities. So they have a contractual link to inflation as investor fear for inflation is rising. Those assets are responding positively. However, even though the Fed has begun to indicate tapering towards the end of 2021 into 2022, reducing their bond purchase program, you have not seen as serious of a response as you saw in 2013 when Ben Bernanke made similar pronouncements of tapering easing at the time. And so while the 10-year did rise over the quarter, you didn't see a massive move in interest rates. Now, as you move kind of from fixed income over to US equities, you can see that recency bias, that comfort bias of what has worked well recently will work well into the future. And so you've seen that rotation into US, into large cap, into more growth oriented securities. We'll unpack international just briefly in a moment. And then finally on the on the real assets side, anything in the light blue here has some kind of implicit or explicit link to inflation, and investors have been coveting those characteristics, and those prices have been rising. On the fixed income side, as I mentioned, we have seen some interest rate volatility over the quarter. In the third quarter, the intra quarter 10-year yield was at a low of 119. It eventually rose to 152, which is just 7 basis points ahead of where it started, but it doesn't fully capture kind of that move intra-quarter. So quarter over quarter, you don't see much, but you do see a recent change in kind of investor interest. A continuation in interest, though, on the bottom here, you can see that spreads or yield associated with corporate bonds, so those both investment grade and non-investment grade, continue to grind tighter as investors search for yield. Now, what we would mention is, this volatility and opportunity has been a fruitful ground for those portfolios that are less constrained. So if you remember back to our conversations in January of 2021, discussing the opportunity to introduce less index-oriented strategies like unconstrained bonds. Those strategies have had the opportunity to benefit from some of this volatility, and in select circumstances have certainly done so. As we go into the equity markets, again, we're going to have a lot of robust discussion as we round the year and talk about our 2022 outlook. I would mention upper left here just very briefly because we'll unpack this in our coming outlook. But you do see fairly full valuations. Now they aren't as full as they were, as we looked at 6:30. But part of that isn't necessarily prices materially rising, but earnings actually catching up to businesses and expectations. So that has been, part of the theme, as Chris has been talking about, that robust consumer and supporting some of those earnings. Now, as we train our eyes towards the bottom of this page, you will see a notable exception from a country return perspective. That is China. China is a material economy in the global economy. They are a material contributor to emerging markets. As the CCP, the China Communist Party, continues to exert its influence in capital markets and talk about its long-term plan, you've certainly seen a reaction in prices. There's also been no shortage of headlines coming from that country with Evergrande or others, and investor concern has risen. Largely, we think that those headlines and recent actions by the CCP reflect long-term intent and is not a change, but maybe some investors have been recently lured into the idea that China has become a communist, has become a capitalist country rather than a communist-driven market. Finally, as we mentioned a number of times, and we'll continue to mention, real assets is an important discussion point for investors and policymakers, including the Federal Reserve. We've mentioned real assets here. Broad real assets have been an important part and contributor to portfolios as both inflation explicitly has risen, but rising inflation expectations, which often drive sentiment and prices just as much as anything else, have driven these markets up. Energy, largely left for dead as we left the pandemic, has certainly seen a material move off of the bottom. Some might remember when WTI traded negative, it is now above $80 per barrel, but it's not just oil. We see natural gas prices moving materially here domestically, also across Europe and Asia. Even ahead of winter, which is usually a time where natural gas prices, a material input to heating costs, might rise if you have a cold winter, but we're seeing, almost hoarding, if you will, in some of those spaces. So the energy complex has continued to prove as a source of inflation, but also for investors that own those assets, either through diversified real asset pools or otherwise, a potential hedge against rising inflation. And then lastly, here on the REIT side, another asset class that is known for its notable properties for potentially hedging against rising inflation. Largely the pandemic trade, especially on a year-to-date basis, continues to remain. So those sectors kind of left for dead. Think of self-storage or lodging. They have outperformed those like office or others. So we do see real assets and real estate continue to prove to be a good inflation-related asset, and prices have certainly rebounded as a result of that. So as Chris mentioned out of the gate, this is designed to be a very quick touch on the quarter and really preview some things to come. As we round out the year and we begin to talk about 2022 current outlook, etc., we will be producing a lot more material and information on capital market assumptions as we go forward. Kind of our looking through our looking glass into what's going on in 2022 and the inferences on portfolios and allocations. So should you have any questions in the meantime, please feel free to reach out. But otherwise, we appreciate you dialing in and listening. Thanks so much, everyone.